Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at WisdomTree Asset Management. Treasury floating rate notes remain a cornerstone bond strategy. That's what we're going to talk about this week. You know, with the Fed resuming their rate cut cycle, investors have been asking what fixed income strategies should they be considering in this quote unquote new investment setting. And in my opinion, there remains one approach that continues to stand out, and that's Treasury floating rate notes. With the Fed already cutting the Fed funds rate at the September FOMC meeting and likely embarking on one or two more of these easing moves in the months ahead, investing in FRNs may be viewed with some skepticism. You know, indeed, typically FRNs are associated with rising rates, not falling rates. However, as investors have been witnessing post-September FOMC, Treasury note and bond yields do not necessarily completely follow suit. In fact, they can still rise. And this is exactly what has transpired in the 2-week period following the most recent Fed rate cut. As I'm talking to you here today, Treasury 2, 5, and 10-year yields, as an example, which is a pretty good example, have seen their respective yield levels increase about 20 basis points from when the actual rate cut was announced the afternoon of September 17th. Now, why is this important, you may ask? Well, let's go back to Bonds 101. Yield increases equals lower prices. In other words, if you had bought one of these Treasury securities in the wake of the Fed's rate cut, you now have lost money. And it's important to remember that these are fixed coupons as compared to a Treasury floating rate note, which obviously floats. And with respect to Treasury floaters, that floating mechanism is tied to the weekly 3-month T-bill auction, plus a spread. So while the 3-month T-bill yield will fall along with the Fed funds rate, the spread over the T-bill provides a nice cushion and yield advantage. And what we've seen is that the yield curve for Treasury floating rate notes versus most other Treasury securities is either flat or inverted. In fact, the 20 and 30-year bonds are the only two maturities with yields visibly above FRNs. And in the meantime, the floating rate yield is anywhere from about 15 to 45 basis points above the 2 to 7-year sector. So what about the path ahead? At the most recent 3-month T-bill auction, the yield came in at 3.86%. So that means the yield is already pricing in another 25 basis point to come from the Fed, because the new Fed funds trading range would then be 375 to 4, and 386 is about right in the middle of that band. In other words, the floating rate yield of 406, which is where it was as I'm talking to you today, represents about a 20 basis point positive spread to the T-bill yield and arguably allows for another quarter point cut from Powell & Company. So the bottom line, if you're looking to take advantage of the Treasury floating rate note strategy, you should consider the WisdomTree Floating Rate Treasury Fund, USFR. That's it from here. I hope everybody has a great rest of the week. And before investing, carefully consider a fund's investment objectives, risk charges, and expenses contained in the prospectus available at wisdomtree.com/investments. Read it carefully.